Hello there, friends. Welcome back to my channel where we help restaurant owners and hospitality businesses structure, grow, and exceed your business goals. In today's video, I will be going over some of the tax write-offs you can take as a restaurant or hospitality business owner. Have you been asking yourself how you can reduce your tax liability before the end of the year? Typically, when you're in business, you have many high expenses like payroll, including yours, I hope, payroll taxes, sales and state taxes, supplies, products, which could be your cost of goods sold, equipment, lease or rental from your location or equipment, also contract workers, workers' comp insurance, and liability insurance. Other ways that you can reduce liability can include number one would be depreciation, which comes into effect when you make a certain amount of money. Some of those examples are buildings, machineries, vehicles, equipment, and of course tangible property like patents, copyrights, and computer software is depreciable as well, which could be considered as well as capital expenses that really allow you to recover the cost of other bases of the property, or if you need to make leaseholding improvements as well. Now, make sure that you check out the qualifications when it comes to depreciation. Number two, startup cost can include but not limited to $5,000 in business startup costs and $5,000 in organizational costs, but only if your total costs are $50,000 or less. If your startup costs in either area exceed $50,000, the amount of allowable deduction will be reduced by the overage. Number three, qualified business income, which is QBI. 20% of your profits typically are what you can reduce. You can use it with LLCs, partnerships, S corporations, trust, or estates. There are limitations like taxable income and the type of trade or business you're in, and if your income is less than zero, you won't qualify for this deduction. Now, if you don't even know how or where to get started, click on the link below and schedule a free chat with me or my team. Now, you might be asking yourself, what other expenses can I take advantage of? Some of them are operating expenses. They're required for the day-to-day functioning of your business. On the other hand, capital expenses are expenses a business incurs to create a benefit in the future. Operating expenses and capital expenses are treated quite differently for accounting and tax purposes. Now, for the most part, tracking expenses can be difficult for your restaurant or hospitality business, but you can track them through QuickBooks, Xero, or Wave so that you can take a big chunk out of your tax liability at the end of the year or before the end of the year. Now, these expenses can vary. You can have fixed costs like your rent or some of your utilities. You can have variable costs like food because prices change every day. Semi-variable, this can be your labor due to having both hourly and salaried staff. These are also some other write-offs that you can take, which would be like your advertising expenses, your driving expenses, deliveries to customers, maybe trips to pick up supplies or food, And typically, the deductible cost per mile for 2021 is 56 cents. Now, on the most part, do you think that you have maximized your write offs, or could they be better? Here are a few other expenses you can take or write offs. Number 4, leasing or buying a car for your business. Make sure that the vehicle is being used for business purposes, because the moment you start commingling personal with business, it starts getting really sticky. Leasing can also be deducted as well as the interest. If you buy the vehicle, you can depreciate it up to 50%, but it must be used for business purposes. You might be asking yourself, should I take advantage of these write-offs, and why not? If your plan is to decrease your taxable income to lower your tax liability, then use all the write-offs. But if your goal is to show more income, then these write-offs are really not the best way to go, right? So make sure you know what your plans are, not get confused with write-offs or credits, because credits subtract an amount from a person's taxable liability, while a write-off or a deduction is a qualifying expense that reduces the amount of income that can be taxed. Deductions can be simple to find when your books are kept in order. As long as you're speaking to a specific tax strategist about your restaurant or hospitality. The one thing I want you to take from this video is that you can learn how to do this. But if you find yourself overwhelmed, you might want to outsource this work to a professional or find a strategist that can handle your specific needs. So, change how profitable your restaurant or hospitality business could be from last year and see how much it can increase profits for many future years to come. What happens if you don't take advantage of these write-offs I mentioned before the end of the year? You could end up paying thousands of dollars in taxes. This is a reminder to all of my restaurant or hospitality business owners. If you find yourself not having the time to implement these write-offs, or you would like some help sorting this out, we have set aside some time to speak with you. So click on the link below for a free strategy call. Thank you guys for watching our video. If you found this video to be helpful, please share and subscribe to our channel, as well as hitting the bell notification, because we create videos weekly where we help you structure, grow, and exceed your business goals. See you next week. Adios, amigos. Bye.